Research report on key time nodes for U.S. debt repayment in 2025. Introduction. Overview of U.S. debt status and repayment pressure in 2025. As of the beginning of 2025, the total U.S. federal debt has exceeded $35 trillion, reaching a record high. Among this, the principal and interest of Treasury bonds due in 2025 amount to approximately $9 trillion, accounting for 25.4% of the total debt, indicating a concentrated outbreak of repayment pressure. In terms of temporal distribution, the maturity volume in the second half of the year accounts for 70% of the annual total, with 42% being one-year short-term low-interest Treasury bonds issued during the pandemic 2020-2021. These need to be refinanced at the current high interest rate of 4.8%, which will significantly increase the government's interest expenditure pressure. This report focuses on the two key nodes of U.S. debt repayment in 2025 June and September and analyzes their potential impacts on U.S. fiscal and monetary policies as well as global financial markets. 2. Analysis of core time nodes for U.S. debt repayment in 2025. June, the largest single-month maturity peak in history and refinancing challenges. Maturity scale and structure. June 2025 will see a super peak of U.S. Treasury bond maturities with a single-month maturity scale of approximately $2 trillion. Among this, $1.2 trillion are low-interest Treasury bonds issued in the early stages of the 2020 pandemic, with coupon rates generally below 1%, which will mature first on June 15th. The remaining $800 billion are short-term bonds issued in 2021, with maturity dates distributed in late June. The Treasury needs to complete the issuance of approximately $1.2 trillion in new bonds from June 1st to 15th to redeem the old bonds. This scale is equivalent to 5.3% of the U.S. GDP in 2024, far exceeding historical levels in the same period. Refinancing pressure and market impact. Soaring interest rate policy implemented by the Federal Reserve. The low-interest Treasury bonds issued in 2020 were able to be financed at low rates mainly due to the zero-interest rate policy implemented by the Federal Reserve at that time. In 2025, the U.S. federal funds rate remains in a range of 4.5% to 4.75%, and the yield on 10-year Treasury bonds is about 4.8%, so the issuance rate of new bonds has increased by more than 4 percentage points compared with that of old bonds. Calculated based on $1.2 trillion, the annual refinancing interest cost for June alone will increase by approximately $48 billion. Liquidity shock risk. The Treasury needs to complete more than $1 trillion in bond issuance operations within 2 weeks, which may lead to an imbalance between supply and demand in the Treasury bond market. If the Federal Reserve does not purchase Treasury bonds through quantitative easing, QE, selling tide may occur in the market, pushing up Treasury bond yields and driving up broad-spectrum interest rates such as corporate bond and mortgage rates, thus squeezing the financing space of the private sector. Treasury's response strategies. The Treasury bonds such as 5-year and 10-year to induce short-term issuance. Strategy of swapping long-term for short-term, that is, issuing longer-term Treasury bonds such as 5-year and 10-year to reduce short-term refinancing pressure. However, this move may face investors' concerns about the upward trend of long-term interest rates, leading to a further increase in the issuance cost of new bonds. In addition, the Treasury needs to communicate in advance with major buyers such as the Federal Reserve, foreign central banks, and large institutional investors to ensure the smooth completion of bond issuance. September. Dual pressure of sub-peak and corporate bond extension risk. Scale and characteristics of Treasury bond maturities. The maturity scale of Treasury bonds in September 2025 will reach $1.3 trillion, mainly one-year short-term Treasury bonds issued in September 2021, with interest rates of about 0.5% to 1%, which need to be refinanced at the current interest rate of 4.8%. Different from June, about 30% of the bonds maturing in September are Treasury inflation-protected securities tips, and their principal repayment amount is adjusted with the inflation rate. If the U.S. inflation rate rebounds to more than 3% in the first half of 2025, the actual maturity scale of TIPS may further increase. R. Chain reactions in the corporate bond market. Corporate refinancing pressure. The maturity scale of U.S. non-financial corporate bonds in 2025 is about $1.5 trillion, among which September is the peak, about $400 billion. Some corporate bonds were issued during the 2020 pandemic, with low coupon rates about 3% to 4%. When the Treasury bond yield remains at a high level of 4.8%, the credit spread of corporate bonds may widen, causing the interest rate of high-rated corporate bonds to rise to 5.5% to 6%, and the interest rate of junk bonds to break through 8%. Some enterprises with tight cash flows may face difficulties in borrowing new to repay old and even triggering new to repay old and even trigger a default news. Exposure of financial institutions to risks. U.S. commercial banks, mutual funds, etc. hold approximately $5 trillion in corporate bonds. If the corporate bond default rate rises, the historical level in 2024 is 1.2%, and it may rise to 2.5% in 2025. Financial institutions may face asset impairment pressure, thereby tightening credit and aggravating economic downward risks. 3. Impacts of U.S. debt repayment in 2025 on the economy and policies. E. Challenges to fiscal sustainability. E. Soaring proportion of interest expenditure. In 2024, the interest expenditure of the U.S. federal government was approximately $600 billion, accounting for 2.6% of GDP. If $9 trillion of debt is refinanced at an interest rate of 4.8% in 2025, the annual interest expenditure will increase by approximately $432 billion, and the total interest expenditure will exceed $1 trillion. Accounting for 3.5 percentages such as infrastructure of fiscal deficits are risk of deficit monetization. If the Treasury's bond issuance is cold, the Federal Reserve may be forced to restart QE and finance the government by purchasing Treasury bonds, which will trigger market concerns about fiscal dominance over monetary policy, weaken the credit foundation of the U.S. dollar, and push up long-term inflation expectations. In March 2025, the break-even inflation rate of 10-year Treasury inflation protected securities TIPS in the market had risen to 2.8%, an increase of 0.5 percentage points compared with 2024. R. Dilemma of monetary policy. E. Contradiction between anti-inflation and debt repayment. If the Federal Reserve cuts interest rates or restarts QE to ease debt repayment pressure, it may lead to a rebound in inflation. The core PCE inflation rate has dropped to 3.2% in 2024, damaging the credibility of monetary policy. If it maintains high interest rates to suppress inflation, the refinancing costs of the Treasury and enterprises will further climb, aggravating financial market turbulence. This dilemma may force the Federal Reserve to adopt a compromise strategy of mild interest rate cuts plus limited bond purchases, such as a cumulative interest rate cut of 50 basis points to 4.0% to 4.25% in the second half of 2025, while purchasing $100 billion of Treasury bonds monthly to balance the needs of anti-inflation and stable financing. R. Potential impact on the U.S. dollar hegemony. Sustained high debt and high interest expenditure may weaken the confidence of international investors in U.S. Treasury bonds. The proportion of U.S. Treasury bonds held by foreign central banks has dropped to 24% in 2024, the lowest since 2000. If the overseas demand for U.S. Treasury bonds further declines in 2025, the United States may be more dependent on domestic private sectors or the Federal Reserve to purchase Treasury bonds, which will be interpreted by the market as debt monetization and accelerate the process of de-dollarization. 3. Spillover effects on global financial markets. E. Fluctuations in cross-border capital flows. The high U.S. interest rate environment may attract global capital to flow into the U.S. Treasury bond market, leading to capital outflows and currency depreciation in emerging market countries. During the concentrated issuance period of U.S. Treasury bonds in June and September 2025, There may be periodic selling pressure on the stock and bond markets of emerging markets. For example, during the Federal Reserve's interest rate hike cycle in 2024, the scale of capital outflows from emerging markets reached $320 billion, and this figure may exceed $400 billion in 2025. Our linkage of commodity prices. If the Federal Reserve turns to easing due to debt repayment pressure, the US dollar index may weaken. The average value of the US dollar index may weaken. The average value of the US dollar index in 2024 is 105, pushing up the prices of US dollar-denominated commodities such as crude oil and gold. Conversely, if high interest rates continue, commodity demand may be under pressure due to the slowdown of the global economy, forming a vicious circle of high debt, low growth, low commodity prices. 4. Risk scenarios and response suggestions. E. Stress test. Analysis of 3 possible scenarios. R. Policy suggestions. E. Short-term response. Optimizing debt management and market communication. The Treasury should announce the 2025 bond issuance plan in advance and guide market expectations through pre-tender communication meetings and other means to avoid liquidity shocks caused by concentrated issuance. The Federal Reserve can establish a Treasury Market Stability Instrument, TMSI, to provide temporary liquidity support at key nodes such as June and September to prevent 无序波动 in the market. 2. Medium-term reform. Promoting fiscal discipline and debt structure adjustment. The U.S. Congress needs to restart debt ceiling negotiations and formulate a cross-year fiscal austerity plan, such as reducing non-essential expenditures and reforming the Social Security system to cut the proportion of annual fiscal deficits in GDP from 6.5% in 2024 to below 3% in 2028. The Treasury should gradually extend the duration of Treasury bonds, reducing the proportion of short-term debt from the current 42% to below 30%, so as to lower refinancing frequency and interest rate fluctuation risks. 3. Global coordination, alleviating spillover effects. The Federal Reserve should strengthen policy communication with other central banks and ease cross-border liquidity pressures by expanding currency swap agreements, for example, increasing the swap size with emerging market central banks from the current $600 billion to $1 trillion. The International Monetary Fund (IMF) could establish a debt crisis response fund to provide short-term financing support to emerging markets impacted by fluctuations in U.S. Treasury bond yields, preventing the spread of systemic risks. V. Conclusion. The debt repayment pressure faced by the U.S. in 2025 is one of the most severe fiscal challenges since the 2008 financial crisis. The key nodes in June and September will serve as a touchstone to test the sustainability of U.S. public finance and the resilience of financial markets. If mishandled, it may trigger a chain reaction such as 失控, out of control, U.S. Treasury bond yields, a wave of corporate debt defaults, and global capital flow disruptions. In the short term, policy coordination between the Treasury and the Federal Reserve is crucial. In the medium to long term, fundamental reforms in fiscal discipline and debt structure optimization are needed to alleviate the debt spiral risk. For global investors, it is essential to closely monitor the progress of U.S. Treasury bond issuances, Federal Reserve policy trends, and changes in credit spreads in the corporate bond market and make risk hedging preparations.